When you get to the point of an LOI, you're still not done. I mean, there's a lot you want to put into that LOI to make it work right. We try to nail down all the terms in the LOI before we get to the end stage to make the deal work. Is it an asset or stock sale? Is it all cash, or is some piece of it non-cash, a note or an earn-out or something else? We want to know about that, and I would say a seller should never sell for anything that's not at least 80% all cash. I mean, it's, and you know, people talk about cold, hard cash. Cash is warm. It's a nice thing. And we want to get cash for our sellers. Will the owners have to sign employment agreements? And if so, for how long? How much are they going to be paid? Will they be asked to buy in beside the buyer if they're an equity fund? A lot of terms, details to those terms that are important. When do they get bought back out? What do they pay for what they buy? All of those things. Will the buyer buy the building? A lot of times the building is owned separately by another corporation that's owned by the owners. Well, do they want to sell it when they sell the business? Usually owners, often they don't care. Often a lease is just as good, and that's okay. We'll talk to the buyer and see what they want to do, and if they want to lease it, how long is the lease? What are the terms? Those things are important to work out before you take the deal. Will the sellers have a cap on indemnifications that they provide? Every seller has to make reps and warranties to the buyer that he's told them truth and that he's told them everything. The buyer will ask for indemnifications if any of that proves to be untrue later. We want a cap on those indemnifications. Usually we can get a cap of 10%, sometimes 5%, sometimes 20%. But we'll get some kind of cap so that, and we want to know when they go away. We want them gone in a year. Often it's 15 months because they want a little time for accounting after that. But we want them gone pretty quickly. We don't want 10-year indemnifications that our seller can't go on with his life. You know, so it's important. Will the buyer need to talk to management or customers before he closes? That's pretty important. We need to know that, and we need to figure out how it's going to work. We don't usually let them talk to management, but if there is one key operating guy that's going to kind of replace the owner, he's probably going to have to talk to him. That's going to have to happen. Most people we don't let them talk to because it does no good for our seller. We've had sellers that have told all of their employees that they're considering sale and have been sorry. We have never had a seller who kept it quiet who was sorry. So, what will the timing be on the transaction? We normally ask for the first draft of the definitive agreement in 15 days. That's pretty quick, but we want them spending money and we want them telling us in writing what they propose. So most buyers will do that. We usually get closing maybe in 60 days, sometimes 90, usually 60. So that can happen pretty quickly. Even after you go through all that and work out all those details on the LOI, you're not done. You still have to work on that definitive purchase agreement. It's 150 pages. It's complex legalese. I normally read that 150-page thing probably 20 times for any one deal. And I probably change every page. But you know what? We've been around 25 years. We have never once had a client sued. We have never once had a client who didn't get every dime of it. And it's because we're really meticulous and careful about all that stuff so that you don't have any surprises. Makes a big difference. Any questions about the selling process?
How often do you let them talk to customers, and how deep do you go there as far as that goes before they do this? I imagine they all want to talk to the customers about what they think.
They would all like to talk to
Is
customers.
it a sensitive area for?
Very sensitive, yeah. And we don't want them to talk to any. As long as they can arrange a mechanism that does not tell the customer we're considering sale, like the survey kind of thing, we'll do it within, I don't know, after we've worked out all the definitive, within a couple of weeks of close. So we do it fairly often. And there's a thing now that equity funds always get. It's new in the last 3 years maybe. They always get a report called a quality of earnings report. And the quality of earnings report says oh, there's too much customer dependency, or ooh, trends haven't been steady for a decade. So those quality of earnings reports sometimes want to lean on the customer feedback as well. So those are kind of a pain in the neck. But
you've talked about sort of the fact that there's a lot of cash right now. They're looking to invest, so it's a good time on the seller side.
Right.
It's a strong time.
Right.
But at the same time, you've been doing this for 25 years. How has that relationship changed in some of the things that you're talking about, where right now the sellers have a lot of power in this relationship? At other times in the past 25 years when maybe it hasn't been that way, how is it flipped, or how is the relationship different?
okay. Well, back in the last recession times, it was harder to find those buyers. You could still have a powerful seller, but he would have to look at an extra 200 buyers to find one that had the money to do his deal. So it was much harder to find buyers. Now it's very quick. That's why we closed this last deal so very quickly. Everybody we talked to made a bid. Everybody was really quick, and that won't happen if we get kind of a recession economy or a downturn in the M&A markets.
How about interest rates? That's one thing that people look at is, what are interest rates doing, or what are they going to do in the future? How much stock do you put into, if interest rates go up a little bit next year, what impact that's going to have on the M&A market?
I think it is going to have an impact. If they go up a little bit, it'll be a little impact. It won't be huge. But if they go up tremendously, I mean, I'm one of these people that I mortgaged my house when my mortgage rate was 17% back a million years. If they go up tremendously, it'll make a big difference in the market appetite and in prices we get.
You talked about without a firm like yours helping, a seller will probably give maybe the wrong information or too much information to a potential seller. Are there a couple examples you could give where a seller should not be disclosing information without any type of protection or intermediary?
If a seller is going to talk to a buyer, period, they should get a signed non-disclosure first conversation right away. It's really important because we've had sellers that we know of that have been approached by some buyer. They were receptive, said, maybe we should talk some more. The buyer went back to a sales meeting and said to a bunch of salesmen, guess who we might buy? That's not a good thing. They really need a signed non-disclosure from the very get-go before they talk to people. It makes a big difference. Now, when we present information to, for example, information to competitors, we will list maybe the 10 biggest customers and what percentage of business each one. We don't say who they are. We'll say something about the nature of their business and the percent that we're dependent on them, but we're not going to tell them details about who they are. We have a client right now that we're selling that is talking to a few head-to-head competitors, and we're not telling them about our prospective new customers. We don't want to just talk about that. Now, we're being a little more open with equity funds about that because they're not a threat of the same type. So, okay. I want to talk just for a moment about transition post-close. The way the company transitions and announces immediately after close can make a big difference on the success of the combination. There are three big issues. First issue I would say is the seller's employees are going to be afraid. They're going to have new bosses. They don't know what the changes are going to be. It's really important to buyer and seller, stand shoulder to shoulder together and announce to employees and reassure them that nothing bad is going to happen. The premium price, if the buyer has really paid a premium price, that protects the seller's employees to a large extent, but they don't know that. They really don't have a sense of that. Secondly, customers are often fearful. You don't want your customers saying, ooh, what if they change their direction or change their style? Maybe I better have an alternative backup source. You don't want that. I mean, it works much better, and often there's no disclosure to Plastics News, to the world at large, for at least a couple of weeks because they want to go talk to the top 5 customers one-on-one. And that's really a good move. The last thing is how the buyer if it's a buyer company, not an equity fund, but a real operating company, how they announce to their employees. They need to announce it to their employees as a very positive thing, and we're going to be together and we're going to help one another and we're going to build as a result of this combination. Often buyers can include management in their incentive plans, in new bonus plans. That can be a very nice step to cement the relationship quickly. Owners and managers can really use the merger and acquisition activities of today to help themselves. If you're a buyer or a seller, 9 out of 10 of the people out there in the executive forces are going to feel the impact of M&A in the next decade of their business life. I would just tell people, keep your eyes open, search for ways to strengthen your company's value, and look for the ways that you see people around you combining to make 1 + 1 be 3. Thank you.